Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back to M&A Unplugged. I'm your host, Domenic Rinaldi. Inherent in every M&A deal is the post-closing risks that both a buyer and seller assume. For buyers, they are assuming the risks that not everything was uncovered during due diligence and something material could pop up post-closing and destroy their return on investment. For a seller, there is typically some type of monetary holdback or liability should something arise post-closing that will significantly erode their cash proceeds from the sale. However, for certain deals, there is an insurance product that will actually shift most of the risk from the buyer and the sellers to a policy that will pay out should a claim be made. This type of insurance is referred to as rep and warranty insurance. And my guest today, Patrick Stroth of Rubicon Insurance, has been helping buyers and sellers navigate this type of insurance so they can have peace of mind post-closing. Patrick is the founder of Rubicon Insurance and a pioneer in applying rep and warranty insurance to lower middle market M&A transactions so that all parties can achieve a clean transition. In today's episode, we will be covering reasons why this type of insurance is important to both buyers and sellers, what's involved in securing this type of insurance, what the underwriting process entails, the costs associated with these types of policies, and how and when to introduce this concept into a potential deal negotiation. Patrick is an expert in this area and has helped facilitate numerous M&A deals using this unique product. So I hope you enjoyed today's episode, but before we get there, if you want to avoid the common deal pitfalls and the risk of losing substantial dollars, you need to know how ready you really are to buy a business. Because I believe proper preparation is so critical to your deal success, we have published a catalog of free resources to help you be better prepared. You can access these resources on our website at k2advisor.com. That's K2, ADVISER.com. Being prepared is critical to ensuring that you maximize returns and minimize risks. Thank you for being here and hope you enjoyed today's episode. Hey, Patrick, welcome to M&A Unplugged.
Well, Dom, thanks for having me here today. It's great to be here.
Yeah, look, as a fellow podcaster, I'm so happy to have you on the show and so happy to dive into today's topic because what you're doing is such a tremendous service for both buyers and sellers. And before we dive into the topic, let's talk a little bit about your background. You know, you provide insurance products. Have you always provided insurance products for mergers and acquisitions, or how did you get into this?
Well, a lot of us in insurance, we weren't, born to dream about insurance as a career. A lot of us it starts as something you did right out of school, and then give it a year or two, see where you are. You blink and you've been in the business for 10 years. It has that hold on a lot of us. I've been a directors and officers liability broker for well over 25 years. And I came into mergers and acquisitions, actually by accident. What happened was one of my clients had a number of companies. He bundled them together and he was selling them to a healthcare conglomerate. And as part of the deal, I had asked him it was over $50 million deal. And as we're getting the D&O and the other policies ready for transition to the change in ownership, I asked him, so what are you going to do with the money? And he just said, I'm going back to the old country, which was Israel. Mm-hmm. And, my wife would have preferred me going to Maui, but, that's where he was going. When the buyer found out that he was leaving the country, they changed the terms of the deal and they set up to withhold more than half the funds for 3 years. And they weren't being adversarial. They just told my client, look, it's nothing personal. It's just, look, if you leave the country and one of your reps is breached and we suffer a financial loss, we can't track you down once you're overseas. So I'm sorry, we just have to do this. So the client comes back to me and he says, Patrick, there's got to be a way we can insure this deal. And I had said, I heard about a product. It is out there, but it's prohibitively expensive. And he just said, price is no object, Patrick, go get it. And the problem in insurance for a lot of us, a client will say price is no object until you give them the price.
Right.
It becomes a huge object.
Yes.
Yeah, and to my surprise, this is 2014, early 2015. And to my surprise, this insurance product, Reps and Warranties insurance, instead of being a 7-figure premium, was a third of the cost that I thought it was going to be. And it was just such an elegant solution for less than $500,000. My client was able to exit with $25 million more cash than otherwise, just because of that product. They were going to hold back $25 million, who wrote a $25 million policy. And so it's just that was the epiphany for me that said, look, I want to, get in where we can add value to these deals without having a claim out there. And what's been nice is I got to say, mergers and acquisitions is the most exciting event in business. I mean, some will argue that an IPO is exciting. Mergers and acquisitions has the potential to change lives, and in some cases, generational change. And to be part of that, to help that happen faster, cheaper, happier, being part of that, who would want to do that? And so that's why my firm, while we're still a big directors and officers liability shop, mergers and acquisitions is our passion. And we focus our energy ever since 2015.
Thus your podcast as well, which focuses on mergers and acquisitions, but we're going to come back to that later on. But for our audience, M&A Unplugged audience, if you could define and describe Reps and Warranties insurance, and then we'll get to, why is it good for both the buyers and the sellers. But let's start with the construct of what is it, where is it used, why is it beneficial?
Great. The Reps and Warranties is named after the section within the purchase and sale agreement, which are the disclosures the seller makes to the buyer. They're called the representations and warranties. And they are just detailing financial information that the seller actually has the authority to sell his shares or her shares to the buyer, elements about the business to, it's very similar to a home inspection if you're going to sell your house to, in a real estate transaction, the condition of the roof, the condition of the plumbing, the electrical, same kind of thing with business. We have this many employees. We have, no lawsuits or other litigation that we're aware of. All those types of things.
You have filed your taxes.
Filed our taxes.
The financials are true and accurate.
All those types of things. And so what that's put out there, it is up to the buyer to, don't take the seller's word for it. They have to perform due diligence and double check, just vet all that information out there. At the end of their vetting, they're going to say, okay, fine, we agree with this. We're going to go ahead and move forward based on the purchase price that we had set up. Or they may make adjustments if they, in diligence, find out a couple things that aren't accurate. Now, there's a position in the agreement called the Indemnification Clause, which means to the seller, essentially, if the buyer missed anything, the seller is personally liable financially to the buyer for any losses the buyer may incur as a breach of those reps. Okay, and that can happen up to years post-closing. Okay, and that creates great amount of tension because you've got on the buy side, they're like, hey, you know what? We don't want to be stuck with a lemon. The sell side, hey, yeah, I don't want to be on the hook for losses that are out of my control indefinitely. I mean, we've got to control this. Well, the insurance industry came along and said, look, we'll look at those disclosures. We're going to underwrite based on how much diligence and how thorough the diligence is on the buyer side. And buyer, if you perform diligence, I'll tell you what, for a couple bucks, we'll take the risk. That indemnity obligation that is so cumbersome on the seller gets transferred away from the deal parties to an insurance company. The buyer benefits because they have certainty that if something does explode and they suffer a loss, they can collect and they don't have to go litigate against the seller. The seller, well, first of all, an insurance policy takes up most of what would have been held back as an escrow. So it replaces a majority of the escrow, so the seller gets more cash at closing. Better than that, though, they have peace of mind because whatever money they get to keep. Because if there is a breach, there's not going to be a clawback from the buyer coming after, then the insurance company will take care of it. So it has the ability to benefit both sides tremendously.
And typically, Patrick, what size deals? And I know the insurance has gotten, more and more cost effective as the years have gone on, but what size deals should people start considering reps and warranties insurance? And what sort of terms should trigger that as well?
Yeah, I think when you've got a deal, traditionally, this was reserved for $50 to $75 million deals, fully audited financials, just quite a bit of rules there for eligibility. Now you could actually look at rep and warranty insurance for a deal as low as $10 million transaction value. Okay, so this is available for add-ons for a lot of companies. We're seeing more of the wavelength. 15 million to 20 million is probably the real sweet spot where we're seeing more and more transactions. What you want to look for is if you've got a company where you've got third-party, quality of earnings or some kind of financial report like that, and that's had some legal diligence out there, and those become eligible. The price point on these policies, minimum cost now is about $200,000. You have to remember that the insurance pricing is based on not the size of the deal, but how much insurance is being purchased. The smallest policies are maybe $2 million, $3 million limit policies. So that's already taking up, a good percentage of a $10 million deal. So you can go there. A lot of times market deals will look to be insured for whatever the indemnification limit is, which is maybe 10% of the deal value. And so we would put a policy in there. The minimum price, usually a lot of policies, the minimum price applies to a $5 million limit policy. So even though you may not need $5 million, it's no difference between a 4 and a 5. So you go with the 5.
Yeah, and let's put a $15 or $20 million deal in the context for a buyer and a seller. In a traditional sort of deal, for certain reps and warranties, the seller could be on the hook for up to the entire purchase price, right? Depending on what the rep and warranty is. Or it could be somewhere around 20 or 30, or there could be an escrow involved that's got 20 or 30% of the purchase price being withheld. That all goes away, right? Or most of it goes away. Maybe not all of it, but most of it goes away if you can effectively deploy reps and warranty insurance, correct?
Absolutely. It's tough when you're talking numbers without slides or anything. I'm more of a visual guy myself, but let's put it in context. Let's say we've got a $20 million deal and they're going to have a $4 million indemnification cap. Okay, that's 20%. And then they want to keep half of that $2 million in an escrow. So you got $2 million cash on hand that the seller can use to mitigate a loss. That's why they usually have the escrow there. So the seller gets, let's say, $18 million at closing, and they got to wait for their $2 million to get out there. Worst case scenario, they lose the $2 million in escrow, and they might get another $2 million clawback. Okay, right. That's without insurance. For about $200,000, you can get a $4 million rep and warranty policy. Now, the whole indemnity cap is covered. That policy will come probably with a $250,000 deductible. Okay, they're never $0. It'll be a $250 deductible. So rather than having $2 million tied up in escrow, you only have to have $250,000 in escrow. Okay, the rest goes to the seller. So now seller exits with $19,750,000, if my math is right, as opposed to $18 million. And not only that, they get, they don't have to worry about a clawback, so they get to keep all that money. Right. I will tell you, and this is a very common question, I guess, who pays for this? Well, the policy is in the name of the buyer, because if there's a breach, the buyer goes ahead and gets the recovery. Okay, well, a lot of times the buyer and the seller, they split the cost of the policy, because even though the buyer is a policyholder, the seller benefits too. So the parties very often split. Okay, so when you're thinking about a seller, I mean, for $100,000 or $200,000, you want to exit with $1.75 million more cash and not have that weight on you. I mean, it's great. I would honestly, the one thing that's a point I do want to make about this between buyers and sellers, Buyers are experienced in M&A. They've done these over and over again, and sellers aren't. And you can't take the human element out of mergers and acquisitions. And so if you're familiar with an M&A process, with the diligence, the indemnification, and all that stuff, that's familiar territory, and it can get scary for your counterparty who's not used to this. And they tend to take a lot of these things personally. And, when we get to these processes, if a buyer can go ahead and offer to the seller, look, we can take away this indemnity obligation. We can take away all of this risk for you. Why don't we split the cost, or are you willing to pay the cost? I will tell you, in our personal experience, 99 times out of 100, the seller will pay for all the cost.
Yeah.
What's the tragedy out there is that you have, strategic buyers that are, 1,000 times larger than their target. And the strategic party just said, you know what? We don't want to deal with that. No, we're not getting insurance. We're just going to have the escrow. And, that's almost, I would borderline bad faith, because if a seller is willing to cover this, then rep and warranty is no cost to the buyer.
Yeah.
And if there is a breach, hey, the buyer goes in, goes to an insurance company. They don't have to claw it back from their counterparty, and which gets real difficult if you buy a company and you're bringing, like in Silicon Valley, a lot of these are acqui-hires. So you're just bringing the team over. And that gets a bit uncomfortable having those conversations.
Yeah. What sorts of things, Patrick, are not covered on reps and warranties insurance? So what sorts of things will the insurance companies, exclude from a policy?
Okay. What's great about rep and warranty is that it's a finite product that's well-defined before anything happens. So you really have peace of mind knowing what's covered and what's not covered. Okay. Traditionally, first of all, it is routine for all rep and warranty policies, although they have gotten a lot broader, where, first of all, if there's anything that about, the deal parties know about it. There's some circumstances, potential litigation, some complaints or whatever, none of that's going to be insurable. Mm-hmm. If there's anything that gets turned up during due diligence, obviously everybody knows about it, that's not insurable. There are unique elements such as if there is a loss, the buyer could benefit from a tax break because they have suffered a loss, they get a tax break. Well, they exclude tax breaks or any other financial benefits that come as a result of a claim, which is a little nuanced. For California domiciled risks, issues like wage and hour or unpaid overtime, that's specifically excluded. Outside of those areas, okay, the coverage is going to provide coverage. The policy will provide coverage on the other reps. And what happens is the issue is just making sure that there are other underlying policies in place that are better suited. An example would be for technology companies having a cyber liability policy. If you've got a big property portfolio, you should have an environmental liability policy. Those are better first step coverages, and that's why the rep and warranty policy doesn't want to, be over there because they're more appropriate policies. But if those policies are in place, such as medical malpractice, we do a lot of healthcare M&A. If there's a medical malpractice policy in place, the rep and warranty policy can sit on top of that policy up to the limit, should that be an issue. So it is a real elegant policy to step in there, but it's finite, so there's no disagreements. One of the things that a lot of people ask about are earnouts or any future payments. Those are not subject to insurance. Covenants, things that are within the party's control, are not covered. Outside of that, if it's not specifically excluded and it's a rep in there, it is covered. And that
so, Patrick, I'm curious, in the case where there might be a primary insurance policy like malpractice and reps and warranties insurance sits on top of it, does the cost of the rep and warranty insurance go down because there's a preceding policy? No, it doesn't.
No, it doesn't.
Okay.
And I would tell you, and here's one other great thing about reps and warranties policies is that I mentioned before, the cost is based on how much insurance you buy. Well, the cost, and this is fairly universal, runs between at a low of 2% to a high of 4% of whatever your policy limit. So if you want a $10 million policy It can be as low as 200,000 or as high as 400,000, depending on how complex the deal is and the industry that is involved. If it's a heavily regulated industry like energy or healthcare, it's got to be on the higher end. If it's a straightforward manufacturing, let's say, it will be on the low end. And 2 is a very low, it hasn't been 2 for a while, but I say 2.2, 2.3 to, maybe right now 3. The market's softened up where it's only about 3%. It hasn't gone up north of 3 yet.
So what's the process that the parties have to go through to secure reps and warranties insurance? And when do you suggest that parties actually engage in that effort? Assuming that, deals under LOI, when should they consider, engaging, and then what's involved to actually secure a policy?
The best time to introduce rep and warranty just as a concept is in the LOI itself, where because you could always take it out, but in the indemnification clause of the LOI, you say, we're going to have whatever amount of indemnity, and we will address it by having rep and warranty insurance. So at least it's built in, so you don't have to introduce that concept later on. Rep and warranty has become so prevalent within private equity that it's now just added in all the time. But now for other lower middle market deals, it's something that wasn't an option a year or two ago. So put it in the LOI stage. And
I think that's tremendous advice, because the more, not that you want the LOI to be the catch-all, because it's impossible, but the more you can define in the LOI, the smoother the deal, the faster the deal. And so that makes a lot of sense.
Absolutely. And it's always harder to wait for there to be, a conflict in the deal, and then somebody suggests at a late stage, oh, why don't we insure it? It's better to have it. You can always take it out if it's not a fit.
Absolutely.
So, we do that. What the underwriters are looking for, we need some very simple things. We need the target companies, preferably audited, but we need at least a year or 2 financial statements, balance sheet, income statement. We would love to get the SIM, the confidential information memorandum, to give context to the deal. And then the draft purchase and sale agreement. We can have those elements right now, immediately, okay? Even though the purchase and sale agreement has to go through negotiation, at least the underwriters have the outline framework for the seller reps that are going to be negotiated to be insured. With that information, underwriters can come up with what we call a non-binding indication letter, NBIL. And what it is, they just look at it and give you general terms saying, at this limit, we will cover these reps at this price. And it will be subject to us looking at the diligence reports, which we can do later. So they outline the costs. There is a premium cost. There is also an underwriting fee, with very few exceptions. Underwriters don't perform diligence. They hire outside counsel to review the diligence reports that the buyer performed. So it's not a whole new set of diligence that's going on, okay? It is essentially, I compare it to composing a white paper, okay? The buyer's diligence team writes the white paper. The underwriters just proofread it. That way they can accelerate, go through this process very quickly. Okay?
And that third-party attorney, is that in-house counsel for the insurance companies, or are they actually going to a third-party attorney to do that diligence?
Most go to a third-party attorney. Some insurance carriers are beginning to bring M&A attorneys in-house, but it's interesting. Virtually every underwriter in rep and warranty is a former M&A attorney, which is interesting. You don't get that on any other class of business. Yeah. But most often, they are farming it out and they're outsourcing it to another outside attorney to go ahead and do the review. So this review, when we get that initial information, it takes 2 to 3 business days, ideal circumstances, to get multiple NBILs from various carriers. So we know their interest level, what they're going to do, and also what are some risk areas that they're going to want to focus on. Because what you want to do is you want to see not only who has the best price, but who's got the real appetite where they're not going to have a lot of friction and ask a lot of questions about the diligence. Okay. Yeah. And that could be that just depending on the insurance company, some like certain industries and others don't. It's just a fit that way. And that's the benefit of having a broker.
Same thing with no different than banks, right? Some banks have an appetite for manufacturing deals and others don't want to touch it. Just
exactly. So You go ahead, we get the NBILs out and everything. At this point, there's been zero cost. Okay. The decision is made, which insurance carrier, which program are you going to move forward with? That proposal, if it has an underwriting fee, that underwriting fee has to be paid upfront. The fees run from $30,000 to $50,000. Under circumstances, if you need a real fast turnaround, it could be as high as $100,000 or $150,000 on the underwriting fee. You pay the fee upfront. Once underwriters have received that fee,
and is that non-refundable, Patrick?
It's a non-refundable fee.
Okay.
We have yet to run into a situation where once the fee's paid, underwriters look at the diligence and say, oops, we declined the risk. Doesn't happen. Okay. So the fee gets paid within about 3 to 4 business days, as long as the underwriters have been given access to the diligence reports and the data room. Okay. It takes them 3-4 days to review what they need to and have outside counsel look at the risk and look at the diligence. They will come up with a series of questions to ask the buyer because they can't obviously go over everything. We schedule a call with the buyer's team and the underwriting team, and it usually takes about 60 to 90 minutes. The biggest hassle is usually just getting everybody available for the call, but then they're going to just cover various elements of the business, the HR element, the tax, the financial reps, the legal reps, if there are operational reps, valuation. How did you come up with a valuation for this company? Because here's one thing that's insurable, is if there is a loss, there could be a diminution of value. I can't pronounce that, diminution of value that is also insurable. They need to have that little, underwriters have to have an understanding to make sure that, okay, if you're, offering, market 10 times EBITDA, okay, well, how did you come up with that? And because if the EBITDA goes down, maybe that 10x goes down too. And that is insurable. So they have that conversation. Once the underwriter call is done, if there are any, hanging items out there, maybe there's a report that, underwriters ask for, they want to look at it. Any of those dangling little things get taken care of within a day of the call, a policy is ready to go. Now the policy, so this entire process from beginning to end, if everything's working ideally, takes 2 weeks. I like saying 3 weeks just because in order to get 2 weeks, it's like driving to work and hitting every green light, on your way to work. Okay. There's always something that will come in. So give yourself 3 weeks. But the process goes like that. If the underwriting call happens more than 4 days prior to closing, underwriters will want what we call a bring down call, where they call the day of closing, the day before closing, and just say, hey, we talked about this last Friday. Has anything changed? They just need a verbal confirmation that nothing's changed. And the policy is in draft form. It takes effect at closing. So it's ready to go. It gets paid out of the proceeds of closing. So again, beginning to end, 2 to 3 weeks.
So Patrick, on the lower end of the deal sizes, we don't typically see audited financials. It's pretty rare.
Yeah.
Will the underwriters require a Q of E? Now the buyers may require it themselves, right? But let's say they didn't for some reason. Do their reps and warranty insurance underwriters want a Q of E?
They need a Q of E or some other third-party diligence. A third-party independent from the buyer has to have reviewed the financials.
Okay.
To get them. So you can get a letter from a CPA firm. And the same issue with taxes too.
Okay. All right. So you should probably count on that you're going to have to get a Q of E done for these deals if they're not audited financials.
Absolutely. And I would say, and here's why that's so important is that probably 80% of the breaches that are insured right now, 80% of the claims relate to restatement of financials or something that was missed in the financial statements. Yep. And that, again, that has the biggest impact. So that's why underwriters are looking.
Yeah. And look, we all know private equity and really sophisticated strategic buyers have all come down market. So $10 million deals where they might not have gotten a Q of E quality of earnings report before are certainly getting them now because the sophistication of the buyer market right now at the lower end. So no doubt about that. So 2 to 3 weeks, you can be parallel processing that along with the rest of the diligence and if you get started early enough, shouldn't hinder or hold up the deal in any way.
No, the only times that we've ever had a deal kind of in a holding pattern is literally when a diligence report, we were just waiting for a diligence report or an audited, the final audit to come through. Once we get those, we're fine. I mean, we're, and this is the value that we bring in these deals is that, there are all these boxes that need to be checked and when you're closing a deal, and you don't want to leave anything unchecked. What's critical, the role that we play, at least on the insurance side, is, we're going to be on top of our clients to make sure that those boxes are checked, because if those get done, we get everything straight away, it makes it a lot smoother. The other thing is that as we approach insurance carriers, it is absolutely essential that if we know what the time frame is and the deadline for closing the deal, we won't go to a carrier unless they commit to us that they can meet that time frame.
Yeah,
okay.
Yeah.
We got to keep that promise, because we don't want to be the one that slows the deal.
Patrick, are there a lot of carriers now providing this type of insurance?
There are, quite a bit compared to 5 years ago. I think there's, when I first did this in 2014, 2015, there were 3 markets. There are as many as 20, even more than that. I mean, more isn't necessarily better, it's just more. Yeah. There are 10, I would say reliably 10 or 12 carriers that have been doing this for the last 4 years. They have an appetite. They have a track record of paying claims. They are sustaining their ability to keep out there and be competitive. And, they have a specific appetite. And there are some, which I really welcome now, that prefer the lower middle market deals. They don't want to write a $10 million limit policy. They want to write a 5, and they can do this all day long. Then we have the other, the AIGs and Lloyds that want to write a $50 million policy. I mean,
and so, and it's some of the bigger names that we would think of when it comes to insurance. I mean, these are known names as far as carriers go.
Absolutely. Companies you wouldn't think about: Hartford, CNA, Chubb.
Okay, so these are quality companies.
And along with AIG, but you've got all the brand name, and these are all billion-dollar surplus carriers. So, I mean, they're in this market and they do well. And I would say one thing about claims real quick, because that's a big thing that comes out on this, is there's not a lot of data on claims because there, quite frankly, haven't been enough policies with it. It's not like auto policies.
Yeah, right.
What we have seen, though, is that, over the last 5 years, AIG is getting good at this, and Liberty Mutual just issued a report too. They're saying, look, of the policies that we write, maybe 30% of them report a claim. Okay, they report a breach. We don't know how big it is, but we've reported a breach. Okay, that means 70% of the policies haven't had a claim reported at all. Of the reported breaches, less than 5% of those actually get claims paid. And it's usually the bigger deals where they're, $100 million policies and they've got a $30 million loss.
Yeah.
Those are the claims that are getting paid. Lower middle market, they haven't had a lot of claims, so it's been real good.
That's great. It's clean. And so, Patrick, your role in this is you're representing the buyer, correct? Because they're the policy holder in essence, but I'm sure you're helping both parties through the process at the end of the day. And how often do the underwriters need to speak to an owner of a business? Does that ever happen?
That's rare, if ever. And it's usually, though, we will have the owners when we're on the conference calls that we have with the underwriters are going to be with the buy side team. And so you could have the CEO, often the CFO is involved, or the in-house counsel of the acquiring company is part of the call. So that does happen quite a bit. We don't talk necessarily with the sellers at all. I would say this is, as a broker, most of our opportunities are actually brought to us by sellers. The sellers are coming in, or their advisors saying, we want, we're looking at this transaction, we would like this option. And then they introduce us to the buyer. And then the buyer, once we meet with the buyer, we go ahead and then speak with them exclusively. The way I look at this is, I have a fiduciary responsibility as a broker to my eventual policyholder, who is the buyer. I also have an ethical responsibility to a seller in this deal, because we want to bring something that is broadly worded, broadly covered, but at a budget appropriate rate. Okay, it's not a blank check. We want to make sure that this is within budget and get both sides in there with a product that's flexible and manageable for all sides.
Well, I have to say, it should be music to buyers and sellers' ears that the price point on this product has come down so much over the years that you could be even contemplating, getting this for a $10 million deal. So that's tremendous access.
Well, and what we really like about this too is, for buyers out there, they may have a commercial insurance broker that's handling their other business insurance, but this is a real specialized line of coverage.
Yeah.
At Rubicon, we just want to stay in our lane with the reps and warranties. We have zero interest in looking at the other lines of coverage. Yeah. And so what's nice is we are a real elegant outsource to say, look, I need a specialist that can do just this finite item, stay in your lane, and get us through to closure, smoothly and elegantly. And we like being in that position.
That's awesome. Well, Patrick, this has been tremendous information. And I think folks who are in this market, and it's been a very active market, should clearly be looking at this product to bridge a gap, to get past reps and warranties, hurdles, which are there in almost every deal, by the way. This is one of the most highly negotiated parts, this in indemnifications in any contract. So what a great way to sort of bridge a gap and get the parties all on the same page. Any parting words that you could offer to the M&A Unplugged audience?
I would say that mergers and acquisitions as a business event is going to be picking up quite a bit in the next years. We see that rates should stabilize where they are right now. And like you said, hey, if you don't have to negotiate over each individual rep or warranty because the insurance coverage takes it, that much less expense with the attorneys, is that less wear and tear on your soul as you go through this. And again, if there's any way that we can go ahead and help make these generational changes in people's lives faster, cheaper, and simpler, we're happy to do it.
Yeah, you're offering a tremendous service, and I know the role that you play in these deals is so critical. You know how to get them done, and you know how to get them done with the least amount of friction. And like you said, a fair deal for everybody. So if folks wanted to reach you, how could they get a hold of you, Patrick?
Yeah, you could, the best way, email or our website, my first initial P and then STROTH, P Stroth, at Rubicon INS, short for insurance.com. Go to RubiconINS.com. We've got mergers and acquisitions on our homepage, so you don't have to search through the site for that. I'm also available on LinkedIn, and our phone number's there, everything else, and happy to talk. Even if you just want a ballpark, I've got this size of a deal, we need this much insurance, what do you think?
Yeah.
Not a problem.
And all of this information will be in the show notes, so you'll have all the contact information for Patrick. Patrick, pleasure visiting with you. Thank you so much.
Hey, Dom, my pleasure, and thank you, M&A Unplugged.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.